Welcome to The Explainer. Today, we're unpacking a really interesting story about a company that intentionally took a huge hit to its revenue. Yeah, you heard that right. And it was all part of a super ambitious bet on its own future.
So let's just jump right in with the central puzzle here, something you see in SBC Medical Group's latest earnings report. On the one hand, their sales took a nosedive, but on the other, the company actually ended up more profitable. So how on earth does that happen?
Okay, let's start with that confusing bottom line. Because when you first look at the company's performance for the full year 2025, it seems to make absolutely no sense. It's the kind of financial report that makes you rub your eyes and wonder if you're reading it wrong.
And here are the numbers in black and white. You can see that stark contrast. Total revenue, down a pretty hefty 15%, landing at $174 million. But then you look to the right, net income, which is their profit, actually went up by 9% to $51 million. It's a classic case of taking one step back, hoping you can take two giant leaps forward.
And if that wasn't weird enough, get this. SBC actually beat Wall Street's expectations. Their fourth quarter earnings per share clocked in at 14 cents, just 1 cent higher than all the analysts had predicted. So, despite these really strange top-line numbers, they still managed to deliver a positive surprise to the market.
So what in the world explains this picture? Well, it wasn't a bad economy or a product that suddenly flopped. Nope. The answer lies in a very deliberate, very strategic shift that the company made. They're calling it their year of transition.
And the CEO, Yoshiyuki Aikawa, addressed this directly. He basically told investors, hey, don't panic. He laid it all out, explaining that these numbers weren't some kind of accident, but the planned result of choices they made to build a stronger foundation for the future. And here's the why behind it. That revenue drop was, believe it or not, entirely planned. It came from two main things: a big business restructuring they kicked off back in 2024, and then a total revamp of how they handle their franchise fees, which started last April. It's all about short-term pain for what they hope is long-term gain.
The profit side of the story? Well, that's actually a lot simpler. See, the year before was weighed down by these huge one-time costs related to their IPO, going public on the stock market. With those big expenses gone in 2025, their bottom line just naturally looked a whole lot better. It gives us a much cleaner look at their real earning power.
Okay, so let's shift gears and look at how this new strategy is actually starting to play out. Because if you look past the full year numbers and really zoom in on just the last quarter of 2025, you can start to see some little green shoots, early signs that this whole plan might just work.
And this chart really shows that turning point beautifully. After that period of decline, the average amount that each customer was spending bounced back in a big way. It hit $316 in the fourth quarter. Now this is exactly the kind of positive sign that management was hoping to see.
Yeah, that's an 11% increase compared to the same time last year. It's a really key number they're keeping an eye on. In fact, management called it a potential inflection point for the company's long-term growth. It kind of suggests that even though they might have fewer revenue streams right now, the ones they do have are becoming way more valuable.
So this brings us to what's next, SBC's future playbook. With that tough transition year mostly in the rearview mirror, the company is now going all in on a new three-pillar strategy that they think is built for the next era of healthcare.
First up, they're not just sticking to what they know in aesthetic medicine. Their goal is to become the absolute #1 player in their home turf of Japan across a whole bunch of different services. We're talking orthopedics, fertility treatments, the whole shebang, all by 2035. Second, they're looking to go global. But, and this is the key part, instead of trying to do it all themselves, their strategy is to team up with established, trusted players on the ground. Their recent investment in Orange Twist, a US med spa, is really their first big move in this plan to build a worldwide presence.
And the third pillar? It's a massive push into technology. They're weaving AI into pretty much everything and launching a brand new corporate wellness platform called SBC Wellness 2.0. It's all about tapping into that growing market for longevity and preventative health.
And their plan for AI is actually super practical. They're going to use it to automate routine stuff, like booking appointments. They'll also use it to help their staff during counseling sessions, to provide better service, and to streamline all their own back-office operations to cut costs and just get more efficient. So, at the end of the day, what's the big takeaway here? Well, SBC knowingly and willingly gave up short-term revenue growth for a much bigger, much more ambitious long-term vision. They basically created their own storm, and now they've weathered it. And that, of course, leaves us with the million-dollar question. The plan is ambitious, there's no doubt about it. But the story to watch now is all about execution.
Can their massive bets on tech, on wellness, and on global growth actually pay off and create a truly healthier, more sustainable business for the long haul? I guess only time will tell.